If you've ever watched a really brilliant, disciplined person, I'm talking a top engineer, maybe a surgeon, try their hand at market trading and just fail again and again, you've seen one of the great paradoxes in finance.
Whoa, absolutely. It's almost a universal story. The market seems to punish the very people who succeed everywhere else,
Right, and it often seems to reward the impulsive instead.
which is the exact theme of the sources we're unpacking today. We're looking at Mark Douglas's huge work, Trading in the Zone. And he frames it perfectly. He says, trading is probably the hardest thing you'll ever attempt. Not because it requires intellect, quite the contrary.
And that line just grabs you, doesn't it? It
Yeah.
suggests that the intellect you lean on in your career might actually be your biggest problem here.
That's the core idea.
So today we're doing a deep dive into this material, which is all about mastering mental discipline. Our mission, really, is to get a handle on why mindset, technical skill, is now the main thing that determines consistent profit.
And to find those specific psychological tweaks you need to make to survive in an environment of total freedom and constant uncertainty.
It's a huge challenge. So to understand why we're even talking about psychology over, say, price charts, we have to look at how trading focus has evolved.
Yeah, it's basically broken down into three big historical shifts.
Okay, let's trace that. Where did it all begin?
It started with what we call fundamental analysis. This was the dominant theory, really, up until the 1970s.
The idea being, if you just understand the economics, inflation, company earnings, you can predict the price.
Exactly. They treated a market like a simple math equation.
But that model blew up, right? Because it assumed everyone was perfectly rational.
Precisely. It totally missed the human element. Trader psychology, the greed, the fear, that created a huge reality gap between the economic theory and what was actually happening.
So the messy human reality didn't match the clean economic
Oh,
model.
not even close.
Yeah.
So when fundamentals failed, that led to the second big shift.
Which one?
Technical analysis. This really took off in the late 70s, early 80s. The technicians, they realized that if people were acting emotionally, then their collective behavior would create patterns.
Identifiable, repeatable patterns on chart.
You got it. And this was a huge leap forward. It closed that reality gap by focusing on what the market was doing right now, not trying to predict the future with economic models.
But that's not the end of the story.
Yeah.
I mean, even with all the technical tools we have today, most people still can't find consistency.
And that's what brings us to today, the third and current shift. Mental analysis.
The inner game.
The inner game. You can have the world's best system, understand every chart pattern, but if you don't have the discipline, the focus, the confidence, you'll still fail. The battle isn't with the market anymore. It's completely internal.
It sounds like the market is the ultimate mirror for your own mind. And that takes us right to this idea of why trading is so alluring in the first place. You said it's this promise of unlimited freedom. Why is that so attractive, but also so dangerous?
Well, think about the successful professionals you mentioned earlier, the engineers, the lawyers. Their lives are built inside tight constraints, rules, protocols, schedules. Trading offers a real escape from that, a place for pure creative expression.
That's the hook.
That's the hook. But as Douglas says, unlimited possibilities coupled with the unlimited freedom present. Unique and specialized psychological challenges.
Because in every other part of life, there are external structures keeping us in check. A traffic light, a boss, a deadline. The market has zero.
None. And that's the paradox. Because there's no external structure, success demands you create your own. Self-imposed rules, ironclad internal discipline.
Right. If I go to a casino, the rules for blackjack are set for me. In trading, I have to be the player, the rule maker, and the cop enforcing those rules, all at once.
And this is where our own conditioning trips us up. We're raised to follow external rules. Don't do this, do that. So when we get to the market, we unconsciously resist creating our own rules because it feels like we're giving up the very freedom we came for.
It feels like putting on a mental straitjacket. I remember reading this one story in the material about a trader who felt like setting a stop loss was, for him, suppressing his own creative impulse.
That is so common. People crave that spontaneity, but that resistance to structure leads straight to erratic, random behavior. And this all boils down to the single biggest hurdle a trader faces, taking responsibility.
It sounds so simple, but I'm guessing it's not. What does taking full responsibility actually mean here?
It means accepting, deep in your bones, that all your outcomes are self-generated. The wins, the losses, everything. They come from how you choose to interpret information, the decisions you make, and the actions you take.
So if you blame the market or the news or your broker,
You've given away all your power. You can't learn, you can't adjust, you can't improve.
and the market has this perfect psychological trap to stop you from taking that responsibility, the random rewards.
Yes. That one unexpected big win is so incredibly dangerous. It gives you the same dopamine rush a gambler gets. And that feeling immediately overrides all the patient, disciplined work you're supposed to be doing.
You start chasing the thrill.
You start chasing the thrill instead of just executing your edge. You get addicted to the possibility of a win, not the process of trading well.
This feels like a good place to talk about what separates the winners from the losers. It's not that winners never lose. It's how they deal with it.
Absolutely. Losses are just a cost of doing business. They're part of the deal. The real difference is the response. A consistent winner accepts a loss without emotional pain. They budget for it, they expect it, and then they just move on.
And if you can't do that, if you see every loss as this traumatic personal failure,
Then you're destined to be a consistent loser. Or, maybe worse, you get stuck in that painful boom and bust cycle forever.
okay, so let's dig into that. If a trader logically knows they should accept a loss, why do they still make those classic mistakes? Moving their stop, hesitating, revenge trading. What's overriding the logic?
That is the million-dollar question, and it gets us to the heart of the trader's edge. Douglas argues that these errors don't come from the market. They come from fear-driven attitudes.
Fear of what, exactly?
Primarily the fear of losing money.
Hmm.
But even deeper than that is the fear of being wrong. Those two fears just distort your perception of reality.
And this is where perception gets really fascinating. We think the market is threatening because it can take our money.
But the market itself is just generating neutral information. That's it. Price goes up, price goes down. It's just data. It's our own mental baggage, our memories, our beliefs, especially our past painful trades that paints that neutral data as threatening.
You're talking about that analogy from the sources, the child and the dog.
It's the perfect illustration. A kid gets a bad bite from one dog. Now, for the rest of his life, he fears every dog he sees. It doesn't matter if the new dog is friendly or not.
The past experience is coloring the present moment.
Exactly. A painful loss in trading creates that same kind of emotional link. You see a setup today that is totally unique, but your mind instantly connects it to the pain of that last loss. And what happens? You hesitate, or you miss the signal entirely. The fear isn't from the market now, it's from a memory.
So the goal is to break that connection, to, as you said earlier, debug your own mental software.
Precisely. Douglas sees beliefs as structured energy. This is such a critical idea. If you believe the market is out to get you, that belief is a real energy force in your mind that actively blocks your awareness. It's like a piece of code that just flashes danger and makes you freeze up.
So my belief literally stops me from seeing opportunities that are right there on the screen.
Yes. He says, people see what they've learned to see and everything else is invisible. Until you learn how to counteract that blocking energy. A tiny shift in how you see risk can open up a whole new world of possibilities you couldn't perceive before.
And this shift is the foundation for what he calls true risk acceptance. So if fear is the problem, what does true acceptance actually feel like?
It's being completely emotionally detached from the outcome of any single trade. A pro trader, before they even enter, has already decided exactly what they're willing to lose, and they've accepted that loss emotionally before they click the button.
So they've already paid for it, psychologically.
Yes, it's just a business expense, not a reflection on them. And once you've done that, the market can't really hurt you emotionally. There's nothing to be afraid of. You just cut the loss systematically because you already accepted it.
Okay, let's connect that mindset, that detachment, to how the market actually moves. This idea of thinking in probabilities sounds like a contradiction. How do you get consistent results from something that's fundamentally random?
You have to think like a casino. It's the best analogy there is. A casino has no idea who's going to win the next hand of blackjack.
Right, the outcome of any single event, the micro level, is completely random.
Completely. But the macro level, over thousands and thousands of hands, that's totally predictable. The casino makes consistent money because they have a small statistical edge, maybe just 4.5%.
And they play it out over and over.
Over and over and over. Traders have to do the same. We have to accept the micro reality that any single trade is a toss-up. But we have to trust the macro reality that over a large number of trades, Our edge will produce a consistent result.
That requires a huge mental shift. You have to let go of needing the next trade to be a winner.
Completely. And to get there, you have to truly integrate what Douglas calls the 5 fundamental truths. They're designed specifically to get rid of that fear of being wrong or losing.
Okay, let's go through them. What's the first one?
First, anything can happen. This is about letting go of control. If anything can happen, there's no point in trying to be right.
I see. That gets rid of the anxiety. And the second?
Second, you don't need to know what is going to happen next to make money. This frees you from the need to predict. You just need to know that the odds are in your favor over time.
Okay, what's third?
This is the hard one for most people. Third, there is a random distribution between wins and losses for any given edge. This is so important. It means a string of losses isn't a failure. It's just part of the random sequence. In fact, every loss actually brings you statistically closer to your next win.
That completely reframes what a loss is. It's not a threat. It's a necessary step.
It is. Fourth truth follows from that. An edge is nothing more than a probability indication. It's not a guarantee. That takes the pressure off. Even the best setup can fail.
And the final one, which ties it all together.
Fifth, every moment in the market is unique. If you truly believe this, you break that chain of association. The last trade has no connection to this trade. The market is always new.
This all sounds like a kind of a state of mental clarity. No expectations, no bias.
That's the goal. It creates a state of availability. You just show up to the market with no agenda. You're not high from your last win or scared from your last loss. You're just available, open to what the market is telling you right now.
Which is what people mean when they talk about the zone, that effortless state where you're just in flow with the market. But that seems so advanced. How does someone even begin to move toward that?
Well, it's a process. Douglas lays out 3 stages. The first is the mechanical stage. Here, your only job is flawless execution. You follow your system to the letter, no matter what. You're just building self-trust and training your brain to think in probabilities.
So you're building that internal structure through pure repetition, proving to yourself you can do it.
Exactly. Once you've mastered that, you move to the subjective stage. Here, you start using your experience and knowledge a bit more creatively. But you're still hyper-aware of your biases, and you're guarding against those old errors.
And the final step is the intuitive stage, the zone.
That's mastery. Your intuition is just spontaneous and fluid because there's no internal fear fighting against it. Consistency isn't something you force with willpower anymore. It's just who you are. Your actions are effortless because your mind is perfectly aligned with the market.
This has been an incredibly clarifying deep dive. I think the biggest takeaway here is the need to recalibrate. Success in trading isn't about finding a magic indicator.
Not at all.
It's all about taking personal responsibility, getting rid of that fear, and aligning your beliefs so you can see the market for what it is. A game of probabilities.
It really is 100% an internal game. And here's a final thought for you to take away, and it connects back to that idea of beliefs being structured energy.
Okay.
If you find yourself consistently self-sabotaging, cutting winners short, letting losers run, that behavior is being fueled by an active, conflicting belief. Maybe it's a belief like, I'm not worthy of success, or the market is too dangerous.
So the problem isn't the action itself, but the belief driving it.
Right. And that energy is fighting for expression. The solution isn't to try and fight or destroy that old belief. That rarely works. The strategy is to deactivate it.
How do you do that?
By consciously creating new positive experiences. You execute trades flawlessly, win or lose, and you consciously direct that energy toward building a new desired belief. Like, I am a consistently successful trader. It's a subtle shift in energy management, but it's the key to effortless mastery.
It's not about deleting the old file. It's about creating a new one and using it more often. That's a powerful idea. So the question for you, our listener, is this. What hidden unconscious belief might be running in your background right now, actively fighting against your goals and keeping you from stepping into that zone? That might be the next deep dive worth taking.